This is The Real Story with Michelle Makori.
There was a quiet meeting at the Fed of New York last week. Not public, not pre-planned, pulled together at the very last minute, and it is telling us a lot about the pressure building in the plumbing of the financial system. Now, according to sources, the president of the New York Fed, John Williams, convened representatives from many of the 25 primary dealers. These are the banks that underwrite government debt. If liquidity tightens, they are the first to feel it. And the Fed held this meeting wanting to get a gauge on liquidity drying up, why stress is rising in the repo market, and why the Fed's own backstop is not being used the way it was designed to be used. But before we go deeper, let's break down the repo market and why this matters. A repo or repurchase agreement is the most basic building block of liquidity. One party gives cash, the other posts the United States Treasury as collateral and agrees to buy it back the next day at a slightly higher price. That higher price is the repo rate, and it is effectively the overnight interest rate that banks and dealers pay to borrow cash against safe collateral. It's the real-time heartbeat of global dollar liquidity. Now, why is it so important? Because every major institution relies on it. Primary dealers use it to finance huge inventories of government debt. Hedge funds use the repo market for leverage. Money market funds use it for safe yield. And the Federal Reserve uses it to make sure that monetary policy actually reaches the real economy. So when the repo market is calm, the system is liquid. When repo rates drift above the Fed's own target, the system is tightening. If they spike, the system is under stress. If they explode, you get emergency liquidity operations just like in 2019. All right, now back to that quiet New York meeting. Roberto Perli, the head of market operations at the New York Fed, reportedly admitted that some borrowers are now unable to secure funding at or near the interest rate on reserves. He said that the shares of trade happening above that level has climbed back to the levels we last saw in 2018 and 2019. Now, those were the years right before repo snapped and forced the Fed to intervene. And here's another issue here. The Fed created the Standing Repo Facility to prevent exactly this. It is supposed to cap short-term rates and keep the system calm. But it only works if people use it and they are not using it. You see, if you tap the facility, you risk signaling weakness. Those who used it are only disclosed 2 years later, but there is still a stigma attached. And once lenders sense this risk, they pull back. So the backstop exists, but the people and institutions that need it are reluctant to use it. And here's a detail that underscores just how real this pressure is. In the days and weeks leading up to this quiet meeting with primary dealers, the Fed had already injected a significant amount of liquidity into the banking system. Estimates show that roughly $125 billion flowed in through short-term funding operations. Now, these flows come from movements in the Treasury's account, money leaving the reverse repo facility, and routine open market operations that add reserves. $125 billion of what's been called shadow QE. Now, under normal conditions, that amount of liquidity should cool short-term stress immediately. It should steady repo rates. It should ease the pressure. But instead, repo rates kept drifting above the interest paid on reserves. The strain did not disappear. The liquidity was absorbed on impact. And that tells you exactly where we are. The system is very, very tight. The buffer is thin, and the Fed is already working behind the scenes to keep the plumbing from seizing up. Now, layer on top of that 3 years of quantitative tightening, reserves drained out of the system, banks shrinking balance sheets to tidy up their regulatory optics. Liquidity is thinning in all the wrong places. And this is why the Fed pulled primary dealers into a private room. This is why you should be paying attention, because when repo shows stress, every asset class feels it. Treasuries, credit, equities, commodities, derivatives, crypto. That quiet meeting in New York is the signal that the Fed sees the pressure building. So what could happen next? Well, if this pressure continues, the Fed will be forced to act. They've already said that as of December 1st, they're ending quantitative tightening. That's the process that sucks out liquidity. So what else can they do? Well, they can adjust the interest rate on reserves. They can push primary dealers to try and normalize the use of the Standing Repo Facility. And they can expand access to the backstop. And if needed, they can inject liquidity outright through repo operations. Now, they won't call it easing. They'll call it market functioning. But the outcome is the same, more liquidity. And that brings us to gold, because gold benefits from instability and from the policy response to instability. So when the repo markets strain, gold can wobble in the first phase because funding stress forces investors to sell whatever is liquid to meet margin calls. That could also be gold. That is what happened in 2008 and again in 2020. But it is temporary. The second phase is where gold shines. When the Fed steps in to stabilize funding markets, the psychology shifts instantly. Now, the market knows the playbook. Gold prices jump ahead of the curve. Gold rises when liquidity injections begin and in anticipation of that liquidity. So even if the Fed refuses to call this QE or rebrands it, gold rises on what is effectively money printing. So here's the bottom line. When the Fed pulls primary dealers into a room, it is a warning. It is trying to fix the cracks, and one way or another, that means more printing, more debasement. And that is the real story.
This is The Real Story with Michelle Makori.